Welcome everyone to this week's edition of the Commercial Real Estate One-on-One Meetup Group. For those of you guys who are tuning in for the first time, we actually started this group back in April of 2020, kind of in response to COVID. And ever since then, we've been trying to become kind of the watering hole when it comes to learning about the commercial real estate industry. And today we have the honor of hosting Lonnie Hendry, you've recently got a promotion to the Chief Product Officer of Trepp. So first off, congratulations on that. I actually connected with Lonnie. He did a kind of a market update for us over here in Kentucky, kind of our regional update a little bit last year. And provided such great insights. And obviously you're connected with Bo Barron, who's a friend of ours, a friend of mine as well. So, again, there's a lot of connection points there. And ultimately we thought it would be great for you to come on the show to kind of talk a little bit about a topic that I know is obviously a very prevalent one in the commercial real estate landscape, and I'm sure a lot of people don't necessarily know the nuances of, which is the CMBS market. So first off, welcome, Lonnie.
Yeah, thank you for having me. Looking forward to the discussion today. And I enjoyed my time in Kentucky, and got to meet a lot of nice folks, and hoping to add some value today and talk through some commercial real estate. I love doing that.
Absolutely. Well, first off, I guess before we get kind of in the meat and potatoes of the actual discussion, I figured it would probably be a good opportunity for you to kind of share a little bit about yourself, your background, and kind of what got you into the commercial real estate space.
Sure. Yeah. So I've been a lifelong commercial real estate guy. After high school and in college, I worked full time for a local multifamily owner, operator, developer. So I really cut my teeth in the commercial space on the multifamily side. So did a lot of luxury, high-end Class A development, bought land, got entitlements, put up the properties, leased them up, and then we sold them off. And actually had a little stint doing some low-income housing tax credit on-site property management. So, have an affinity for multifamily going back to my early days. Through education, undergrad, grad school, focused all in real estate. So I have a master's in real estate, graduate certificate in real estate development, and then have been teaching at the college level since 2013. Own a small little brokerage shop here in Texas, and then joined Trepp about 5 years ago, and really have enjoyed working at Trepp more than anywhere else. Like it's an amazing place where we connect data to action with practitioners in the marketplace, and so we really turn the insights into something that helps people generate more revenue, create new opportunities for themselves, make better, faster decisions. And so, really enjoyed that. And then, kind of concurrently with you starting this, March of 2020, we started a podcast at Trepp. And so we're like 241 episodes in. I'm one of the co-hosts on the weekly show. It comes out every Thursday. We're at 1.2 million listens. And so if you haven't checked us out, I'd ask that you do. It's just Trepwire Week in Review podcast. You can get on any of the major streaming services. So kind of a lifelong real estate guy. I love it. I talk it. I teach it. I live it. Ready to jump in.
Yeah, absolutely. And I can attest to the content that they produce with Trepwire. I'm a regular listener myself, and you could definitely tell that you have the heart of a teacher. And again, it's part of that, the way that you just operate. So, I would highly encourage you guys, if you haven't had a chance to listen to Trepwire, follow along. There's a lot of really good information that you guys share and really great dialogue. So definitely worth checking out. So, as part of the discussion, oftentimes with the podcast, this is a very topic centric podcast. So we'll have people talk about, all different varieties of different verticals within commercial real estate. And today, kind of the focal discussion is going to be related to CMBS. So to kind of create or set the landscape, could you kind of share exactly what CMBS is? And then maybe we can go into some of the mechanics of it so that the audience members understand what we're discussing.
Sure. Yeah. So at a core, CMBS is just an acronym that stands for Commercial Mortgage-Backed Securities. So, the CMBS market really took flight in the early 1990s as a new type of investment vehicle for real estate. It's very similar to, say, a REIT, where, as an individual investor, you can buy shares of publicly traded REITs. Therefore, you get some exposure to real estate through the REIT investment, but you don't necessarily have to be an owner operator. You don't have to have requisite skills to actually be an investor. You're effectively just looking at the underlying, the REIT itself, Simon Properties or some others, and saying, hey, we believe in their thesis and we want to go ahead and throw some money into that investment vehicle. CMBS is very similar, where you have a bunch of individual mortgage loans that get pulled up into a security, and it effectively gets traded as a bond on the secondary market. So the CMBS market creates liquidity for commercial real estate loans. and it's an investable asset that really took off in the 90s. And here we are in the mid 2020s, and still growing today. I mean, it ebbs and flows, in terms of issuance and other things as the macro environment changes. But at a core, it's really just the pooling of commercial real estate loans into a securitization that gets traded on the marketplace. And so Trepp was kind of unique in right place, right time when that market opened up. So in the early 90s, BlackRock had a stake in Trepp at the time, and they were convinced that this CMBS market was going to really take off. And so they actually wanted to create a third party that could bring transparency to the markets. And so Trepp was actually written into the reporting structure for all of the CMBS loans. And so that's how we've been, fairly synonymous with the CMBS marketplace since its inception. And we have, probably the single largest repository of property level income and expense financial data piped through our system, because we were actually written into the reporting structure at the inception. And so we're probably, most synonymous with the CMBS world from a data vendor perspective. We've been there since day one.
Absolutely. And you guys track others products as well, correct?
Yeah. So we've over the years, we've evolved as the market has. So, call it 10 years ago, we started a couple of different data consortia. So we have a bank balance sheet consortium called TALR, which is another acronym. It just stands for Trepp's Anonymized Loan Level Repository. So we have lenders across the U.S. that actually give us their loan data every quarter. We go through a process of anonymizing that, but it provides really good insights into trends and transaction activity across the U.S. So you can see, at a zip code level, cap rate trends, occupancy trends, expense ratio, debt yield parameters on the lending side. And we have a very similar consortium with the life insurance lenders as well, called Life Comps. So we actually produce a total return index across the life insurance lending space. And so we have a really kind of a 360 view of the debt markets, predominantly with CMBS, and then more recently with the bank lending and the life insurers.
That makes sense for sure. So just to kind of highlight the mechanics of the CMBS market. So really what it is it's a grouping of a variety of different commercial loans that are packaged together and sold on a secondary market to some investors, which then provides liquidity back to the lenders. So it kind of is a cycle where you issue a note, package it all together, sell it off in the secondary market. Is there any comparison to like a Fannie Mae, Freddie Mac type of scenario, or how, I guess if you could explain a little bit on that, I think it would help.
Very similar. So Fannie Mae and Freddie Mac actually have CMBS structures. So Freddie Mac has what they call like the K deal structure. It's the exact same scenario. So this is not unique to commercial real estate. I mean, you have RMBS, which is just residential mortgage-backed securities. It's the same effective mechanical process. The nuance is just, with commercial loans, the size of those loans generally are significantly more than residential. So, in the heyday, you might have 1,000 or 1,500 residential loans in an RMBS. You might end up with 70 or 100 loans in a CMBS, just because the loan volume, the size is so much larger. But a lot of the Fannie Mae, Freddie Mac multifamily gets securitized and sold in the same exact mechanism. And so we actually track all of the GSE lending in that capacity as well. So we have all the Fannie Mae, Freddie Mac information. And it's really interesting that liquidity component has been very beneficial for the markets at large. And so it's a great tool when things are done effectively and efficiently. Heading into 2007, there was a lot of challenge with the rating agencies and others. The way they were compensated was really based on volume. So you got ratings and so forth that maybe weren't reflective of the underlying collateral. And so if you watch the movie The Big Short, or you kind of go back to those times, it explains a lot about just the securitization process. Coming out of that, there were a lot of lessons learned, and they've really revamped what we call CMBS 2.0 now. And so underwriting standards are much more stringent. And we've seen, even with this disruption in the current environment, there hasn't been significant losses, and we haven't seen liquidity or capital dry up like we saw, heading out of 2007.
So, no, for sure. So kind of in that same vein regarding the driving forces in the CMBS market. So as we're recording this, we're currently in the beginning of 2024. So we've gone through a period of somewhat market dislocation for a variety of different industries, but commercial real estate obviously was no different. So as far as what the driving factors, or if you had to say, okay, what are the couple driving factors that drive how the CMBS markets flow, what would you say would be the driving factors?
Yeah, so there's a couple of things that make CMBS unique. The primary difference between CMBS lending and, say, like traditional bank loan at your regional or community bank would be that CMBS loans by definition are non-recourse. So you're not signing a personal guarantee when you take out a CMBS loan, which is great for borrowers. They prefer that. They don't want to have a personal guarantee if they don't have to. And it creates an incentive for people to use CMBS as a lending mechanism. Now, there's some nuance there in the sense that because you're not providing a personal guarantee, and these things get traded on a secondary market, there's a level of required disclosure and transparency around the loans that you might not have with a traditional bank loan. So that's where we come into play. So every quarter, the owner of the building or the borrower, the sponsor, is effectively required to supply their income and expense data to the lender. That lender then supplies that data to Trepp, and then that's how the traders get access to the underlying collateral information to make informed trade decisions. So you're not personally liable like you would be in a community bank scenario or other type of lender scenario, but you are providing additional insight into real-time operations at the property level. And so that's one wrinkle. I think it creates viability for this sector because people like the non-recourse component. The other thing that the CMBS benefits from, and we're kind of coming out of this part of the cycle, is when interest rates are low, traditional CMBS loans are 10-year terms. So you get 10-year fixed rate money that you can lock in for an extended period of time is viewed very favorably. With the disruption or dislocation that we've seen over the last year and a half or so, with interest rates spiking, it's definitely made locking in long-term fixed rate debt way less appealing. So we've actually seen a slight pivot in the CMBS market where last year they started offering a 5-year option where you can do a 5-year conduit CMBS bond, and effectively you lock in the rates for 5 years instead of 10. I think that was a really smart move in an attempt to kind of capture still some of that interest in the sector, but without locking people into 10-year notes with rates the way they were was not appealing at all.
Absolutely. And when you refer to these 10-year terms, I mean, so, how does the CMBS market work from a refinance standpoint? Because obviously you're trading these securities on a secondary market. So does that affect your ability to then, pivot if you need to pivot with that note? Like, how are those mechanics?
Yeah, so that's a great question. And it's the securities, since they're traded as bonds, effectively the servicers of these deals, they're looking out for the best interest of the bond holders, right? So if somebody wants to refinance out of the deal, traditional CMBS are static pools of loans. So they're not actively managed. You're not trading collateral in and out. So it's not like you can take a loan out of the pool and replace it with another loan. There are some securitized products like the commercial real estate CLO market where they do have some managed pool components. But in a traditional CMBS, the 70 loans that started off on day one of that 10-year note have to be the same 70 loans at the end. If they want to refinance out or they sell the property out, then you have to pay, yield maintenance, or there's prepayment penalties or defeasance. Those things are built into the structure so that those bondholders get made whole on the interest payments. So there is some capability to refi out of a CMBS loan, or there's some capability to sell the asset and for the new buyer to bring their own financing in, but it's not without some make whole provision through either yield maintenance, prepayment, or defeasance.
That makes sense. For sure. So it helps with the logic behind which options to pursue if you are in fact looking at some of these opportunities. And like I had mentioned kind of offline, a big contingent of our listenership is in the brokerage space and obviously are transacting on a regular basis. So from a advisorship standpoint, a lot of times we just want to make sure we're educated about the options out there and the pros and cons of pursuing different options as a result of that. So one of the things that I had questions on is obviously since COVID, we've had some interesting times in the brokerage space. Obviously, there was a period of time where there was massive, dislocation and that no one knew it was happening. That's from, let's call it right when COVID happened, probably to 3 or 4 or 5, 6 months out. And then all of a sudden we had a huge boom of transaction volume because rates dropped significantly. So the investment markets were the velocity was absolutely outrageous. And then come 2022, there was a huge run up as far as the Fed's stance, as far as their constrictive policy on raising the Fed funds target rate. So that obviously has affected transaction volume into 2023, leading into 2024. Obviously this is with all these shifts, that's affecting a variety of different verticals within the space, and obviously CMBS is no different. So if you were had to kind of describe over the last, let's call it 12 to 24 months, what have been the most pronounced shifts that you've seen? And if you could share maybe some of the sectors that have been most affected as a result of that, that'd be
Yeah,
great.
so it's really interesting. What you laid out in 2020, we saw basically everyone pulled the emergency brake. When everything went into lockdown in March of 2020, there was an immediate, 60, 90-day complete stoppage of everything. Then things started to pick up a little bit towards the tail end of 2020. But from an issuance perspective, as soon as things went into lockdown, we didn't see a whole lot of new debt activity in the CMBS market. You fast forward to 2021 though, and it effectively set, records in terms of new issuance. Like the stimulus that the government put into the system couldn't get spent fast enough. Deals were trading like crazy. And so you started seeing an enormous run up in issuance. And, it's interesting, being a lifelong career real estate guy, when you start seeing 1960s, 70s, 80s vintage multifamily all trading at 3% cap rates on trailing 12 NOI, you kind of know you're at the peak of the bubble, like that's where you're at in the cycle. And in 2021, that we got there pretty quick. So obviously macro inflation became a problem. The Fed raises rates. 22 was really interesting because I think people, the first 7 months of 22 was basically the same as 21. It was a continuation. So through January through July of 22, we were actually on pace to exceed 21 issuance, which was record setting. But when the Fed started raising rates from August until the end of the year, there was basically no issuance. And then 23, nobody knew what to expect. And I think 23 was kind of a silver lining. Like issuance was down significantly. I mean, across the brokerage community, depending on which brokerage you read their filings, transaction volume was down about 70% on average is kind of the central tendency there. If you look at the issuance markets across, lenders, life cos, CMBS, banks, et cetera, they were all down somewhere 50% or more. And CMBS was not immune to that. So we saw probably a 60% decline in overall issuance in 23 as compared to 21, 22. But given where we're at, 550 basis points worth of rate hikes in 15 months, unprecedented government stimulus trying to work its way through the system, and then this direct and immediate corrective action by the Fed, the fact that we had issuance at all and at reasonable levels, I think, as I mentioned, is a silver lining for the industry. And I was down in Miami in the first part of January at CREFC, and there was a lot of optimism around, what 2024 holds. I think that's maybe been stymied a little bit with the Fed's kind of pause this last month, where they said we're not going to change rates. Heading out of December, Powell had kind of made a soft pivot and said, hey, we maybe are going to be a little more dovish in 24. If you look at the Fed dot plot, they're estimating rates coming down about 125 basis points. Everyone was heading into January feeling really good and optimistic. Maybe a little bit of cold water was poured on that with the Fed's recent meeting and holding rates steady. But I think generally we survived the massive disruption in the latter part of 22 and 23. Still had some, credit available, capital was getting placed, even though it was at a reduced amount. And 24 probably is set up to be, as good as 23. And I'm thinking, slightly better. I've been on a couple of other shows where I've said best case scenario 2024 is, 30 to 40% better in terms of issuance than what we saw in 2023.
Yeah, and I think it's kind of to your point. I think the uncertainty in the market is what caused the lack of issuance, because if you don't know what rates are going to be in, a year or 6 to 12 months, it's really hard to make educated decisions on, what you're going to purchase. So, obviously 2023 was still kind of that. We don't really know what the Fed's going to be end up doing. And as we started getting into the later tail end of the year, and we started seeing a little bit more optimism in the marketplace, I agree with you. I think 2024 is set up to be definitely a better year than 23, and leading into 25, I think we'll probably have a really big resurgence, which I know a lot of people who are listening to this podcast, I'm sure, are excited about. So regarding the makeup of these CMBS, packages. So, you had mentioned 10-year terms, 5-year terms, the issuance over time. one thing I'm curious about is, what we've seen in a lot of the media outlets is this kind of doom and gloom when it comes to maturities of notes that are coming available. Obviously, there's maturities of CMBS. I guess, have you seen or analyzing with all the data you guys are reporting that there's going to be some concerns as far as certain property types and what that means for the broader market?
Yeah, so it's interesting. I've been saying this over the last month or so, and I believe it more and more each day. Headlines move faster than reality.
Hmm.
And so it's easy to put a headline out there that says everything's falling apart, it's doom and gloom, it gets clicks, and people want to see what's going to happen, right? The reality is none of us really know what's going to happen. And like this term of maturity wall, it has a nice ring to it. We've seen it, brought up in discussion over the last 10 or 12 years when you see a spike or an increase in upcoming maturities. But if you look at 2023 to 2027, the rollover rate, like each successive year's maturity wall, is effectively the same. Like by 2027, it's slightly higher than the previous 4 years, but 23, 24, 25, 26 are all plus or minus a few percentage points in terms of maturity. So are there a large volume of loans maturing? Yes. Can we prove, visually and mathematically that there's not some like huge influx of loans that are maturing this year relative to any other year? Yes. So I think at some level, it just comes back to basic math. Like if you were financed at a 3%, interest rate in your previous loan, and you have to refinance into a 6% or 7% interest rate in the current environment, that's going to cause some problems just mathematically. The cost of the debt is significantly higher. And if you haven't seen commensurate growth at the NOI line, you're going to have a challenge refinancing without having to put some cash in. So it's not, but this is not something that's like new. It's not something that investors haven't dealt with in the past. We've just gotten a little bit spoiled with this super low zero interest rate environment for so long that some of the underlying fundamentals, eroded. If you look at where we're at with prevailing interest rates today, they're no higher today than they've been over any historical period of time. If you look at any 10-year period over the last 50 years, this is kind of what the historical norm is. So, like, yes, office, that's a sector that the headlines probably have a little bit more truth to them because there's been a paradigm shift in how people work. I mean, people now prefer work from home. Even companies like mine that has like an in-office policy, we're only in the office Tuesday, Wednesday, Thursday. So there's just some real legs to the fact that businesses probably aren't going to need as much office space. Some businesses aren't going to need any office space. And employees don't want to make the commute. We've actually seen for the first time in history, urban office has higher delinquency than suburban office right now, which just cements that people don't want to make the commute into the urban core. So there's those things are challenging, and yes, like that is real. But again, it hasn't played itself out. It's not going to play itself out in real time. It takes time. So just to give some context, we had the great financial crisis. We had the run up in '07. GFC really started in 2008. We didn't hit peak delinquency in the GFC until July of 2012. That was at 10.34%. Right now, our overall delinquency rate is about 5-6% in the CMBS universe. I would suggest that we're not going to see peak delinquency in the office sector or CMBS broadly until another 24, 36 months, just because people that have equity invested in properties are going to do everything they can to preserve their position. And so the distress just moves a lot slower than the headlines. Outside of office, though, there's a lot of really good green shoots. I mean, industrial continues to be incredibly strong. Data centers, incredibly strong. Retail had a huge resurgence coming out of COVID. A lot of the talk about big box retailers closing down and the doom and gloom about retail has kind of abated and gone away. Like there's been a resurgence in community shopping centers, neighborhood shopping centers. We see it every week and talk about it on our podcast. If you have a TJ Maxx or a Ross Dress for Less anchored shopping center, those things are trading at incredibly low cap rates and high prices per foot, even in today's environment. Multifamily is interesting. It's got a few cracks starting to rear its head. But really, 23 and 24 were the problem years for multifamily because depending on who you trust, you got about 1.1 million new units being added in 23 and 24 across the U.S., which is the highest unit delivery count since the late 1970s. So if we can just get through 24 on multi, get those units absorbed, people can just maintain cash flow. 25, the supply constraint becomes real again. And guess what happens? There's going to be an increase in rent power for the property owner. and multifamily comes out of this looking really, really good. Some distress in the interim, but generally speaking, like, look, I'm an optimist. I think commercial real estate has proven time and time again it's a very resilient asset class. Sure, people get over levered and some people lose out in these downturns, but generally speaking, it's not going to be, I don't think, to the scale and to the depths of despair that some people would make you believe on the whole.
Absolutely. I would agree with you. And also, even more so that related to lending. I mean, lenders don't necessarily want to take back some of these buildings either. So I would imagine, even though, yes, a lot of these loans do have covenants that dictate that they have to meet certain performance metrics, but lenders still have to enforce those covenants, and the likelihood of them enforcing those covenants, in my opinion, and I could also be completely wrong. I'm not no expert, but I would imagine that they're going to try their best to work out what they can with the people that they can work out with. And obviously, there's going to be scenarios that it's just untenable, and you have to do what you got to do. But if there's any silver lining or any opportunity to make sure that they can keep that loan, performing, I'm sure lenders are going to do everything in their power to make that a reality. Because again, they're not in the property business; they're in the business of issuing loans and collecting interest on those loans. So.
Yeah, I agree, and it's interesting. I apologize, my light just turned off again. The the regulators have been really favorable to property owners, at least to this point, where they've actually instructed lenders to work with borrowers instead of pursuing foreclosures and being very stringent with the covenants. And so that's the one caveat I would say to kind of my general optimistic take is we still have some distress in the banking sector broadly, where you have a lot of lending institutions that are overexposed to CRE. We put out a couple of research pieces in the last month. You have some really sizable banks that have concentration ratios in CRE that exceed historical norms by some multiple. And if, like last week we had, New York Community Bank Corp that came out and had significant charge-offs. Their reserves went up significantly. Basically got rated down to a junk level overnight. If that starts to play out kind of like we saw in 23, where we had 3 bank failures very quickly, that could make me change my perspective broadly on the macro CRE environment. But I think the Fed has made it abundantly clear that they're going to do everything they can to make sure the banking sector stays solvent and people don't lose faith. As long as that happens and the regulator doesn't push lenders to be, overly enforceful on their covenants, I agree with what you're saying. That the incentive is to work with people. I mean, and the reality is this: functionally obsolete buildings are functionally obsolete, whether they're owned by an individual or they're owned by the lender. Like, it doesn't, if the lender takes it back, it doesn't magically recoup the value. And so they have to be pragmatic in their approach to say, what's in the best interest of the person holding the note, whether it be a bank or in the CMBS world, what's in the best interest of the bondholders, to say, how are we going to get the most value out of these assets? And sometimes it's just continuing to operate them, even if in the short term it's a negative cash flow situation, to try to get them re-tenanted, get them released, and create a value add plan to increase the value. We've seen that with some of the regional, super regional malls over the last 10 or 15 years, where they've been written down several times, but they finally get to a basis point where they can operate profitably. And sure, the lenders have to take a haircut and they charge off some of that loan balance, but ultimately it turns out to be the best case scenario of a bad, worst case type of opportunity.
Definitely. No, I couldn't agree more. So, kind of looking forward, we've kind of alluded to it a little bit throughout this podcast episode, but what do you see taking place in the debt markets, and really we can even touch on commercial real estate as a whole over the next 12 to call it 24 months?
Yeah, so I think we're going to see a continuation of a closing between the bid-ask spread. Reality is going to start setting in for some of these folks that are out over their skis. So if you were, somebody that unfortunately took out floating rate bridge debt at the peak of the cycle, and you bought a 1970s vintage property and underwrote 12% rent growth for 5 years after value add, and you're not able to actually even complete the value add and or see the rent growth, like, there's going to have to be some tough decisions made on some of those assets, and you're going to start seeing sellers capitulate to the market. I mean, the reality is, we all know in the commercial real estate, especially on the brokerage side, there's these external factors that actually overpower a property owner's ability to be successful. And so interest rates is as one example, inflation is another, and inflation for CRE takes the form of expense inflation. So even though the Fed maybe says we're close to the 2% target for macro inflation, we've done some analysis. If you're a multifamily operator or an office operator, your insurance cost per year has gone up on average somewhere between 15 and 30%, depending on what market you're in. And in some markets for this most recent renewal period, we're seeing increases over 100%. Guess what? Like, you don't get to automatically pass that back to the tenants in every instance. And so there are a bunch of macro factors that are really going to start impacting some of these operators that were already on the fringe from a debt service or debt yield perspective. But again, I think that's going to be contained to certain markets, to certain property types. And just to give some context, that short-term bridge debt financing that I mentioned, there's been about $125 billion worth of issuance over the last 5 years in that type of a financing structure. That's not an inconsequential amount of financing, but it's not enough to disrupt the entire marketplace. Now, in some local communities where you maybe had a pocket of investors that came in and bought 15 or 20 properties in a secondary or tertiary market, guess what? Like, there's going to be some real downturn in that local market for some period of time. But broadly, you're going to be fine. Office is its own thing. San Francisco, LA, Chicago, over officed. We've never torn down offices in the US. We have a ton of just functionally obsolete Class B and C office buildings that unfortunately have been traded up and up to where the price per square foot's just not supported by the income that they can generate. And so there's going to have to be a reality check there. And I don't know what form that takes. You've seen a lot of headlines around conversion to residential. The reality is it just doesn't mathematically make sense in most instances. The cost to convert is significant. The ability to have to execute on that type of a project is an immense challenge, and not a lot of people possess the skill set to do that. And it requires, in my opinion, some sort of a public-private partnership where you have tax abatements or other incentives to make developers willing to take on that risk. And at scale, we haven't seen any municipalities kind of step up to the plate. There's one or two across the U.S. that maybe have a handful of deals, but that's not going to be like a saving grace for that sector. And then, whether you're a CCIM or you're in the appraisal business or whatever, like, at some level, you have a highest and best use analysis at the site. So it's a 4-step process, legally permissible, physically possible, financially feasible, maximally productive. Well, what happens when you have a functionally obsolete office building, but that site's highest and best use isn't as an office building? You're going to be really hard pressed right now to say we're going to tear this old office building down to build a new office building, even though new office buildings are actually doing fairly well in this market. So I think that's going to be one that won't resolve itself in 12 to 24 months. You're looking at a much longer time horizon. And I know I've gone on a little bit here, but just one last point there. In the office sector, there's sublease availability across the U.S. at record levels. So it's like this shadow vacancy that's not showing up anywhere yet, because effectively on a rent roll, that space is still leased and the tenant is still paying the rent, but they have the space available for sublease. And so you have this bifurcation between actual market level rent space and the sublease space. The full effects of those sublease rents haven't been felt in the marketplace. So if your contract rent for a Class B office in San Francisco, say $60 a square foot, sublease rent might be $35 a square foot for that space. They haven't felt that impact of the $35 rent becoming the market rent. But in reality, there's such an influx of submarket or sublease availability that becomes the market rent in those submarkets. And so Minneapolis is another example, about 4 million square feet of sublease availability. If you just take the average lease size in those markets and divide it into the available sublease space, you're looking at an 8 to 12 year type of time horizon, assuming normal absorption, to get back to some level of stabilized occupancy and rental rate.
Yeah, no, 100%. And that's not unique. Like you said, it's not unique to just, it's happening all metros all across the country. I mean, I think here in Louisville, we have almost 800,000, actively, 800,000 square feet of vacant office space just in our CBD. Obviously it doesn't factor in any suburban office, and the manifestation of the total vacancy hasn't occurred yet because of the fact that there's a lot of employers out there that are looking to potentially sublease their space or whatever else. So I agree with you.
I saw Louisville though. Didn't they just announce something at the city level where they're providing incentives?
Yes, they are.
So that's actually a really good proactive move for them to kind of get ahead of that.
Absolutely. Yeah. So initially what had happened is that they had offered kind of out of a fund, and it's only a $3 million fund now, but hopefully over time it continues to grow. But the logic was, if you're a potential tenant that wants to locate in downtown Louisville, which obviously you can't, be in downtown Louisville and just happen to relocate to another place in downtown Louisville. You have to actually be a net positive to downtown. They would offer you some form of tenant improvement up to $30 a foot. That footprint initially was 50,000. They just lowered it to 5,000. So that's obviously going to create a lot more velocity, hopefully for tenants that want to locate downtown, which is something we definitely sorely need. And I think, again, public-private partnerships like that, public incentives, and then over time, hopefully we can institute more public-private partnerships for either conversions or, as you alluded to with the office buildings, it's really unpopular oftentimes at the city level to say, hey, let's demo a building that looks great to the exterior, but has, obviously functionally obsolete and whatever else. So, hopefully that sentiment begins to change when we start realizing there's a lot of structures downtown that are just not being utilized efficiently. So,
right.
Yeah. And so one last question before we open to Q&A. We usually have time at the end where people can ask particular questions. So if you guys are watching this live on all the different social platforms, feel free to type away in the chat box. We want to make sure we answer all of your questions. But quick question before we do that. Lonnie, one of the things I'm kind of curious about, obviously as a content creator myself, I'm obviously very interested in hearing about your experience with starting Treppwire, and then ultimately, how the lessons you've learned through the process of actually doing so. So I just thought I'd give it to you as an opportunity.
Yeah. So yeah, it's another great question, and it's really interesting. I think it's amazing to see how quickly content has become currency in today's market. So if you look at real estate just generally over the last 50 years, your competitive advantage in the marketplace was having some sort of proprietary, relationship-driven, data stored type of dynamic. So it's like you were in the marketplace, you made friends with a lot of other brokers or owners or investors. You kept your little repository of list of those people to yourself. You didn't tell anyone what you did or how you did it. And it was like your competitive advantage in the market. We've seen a pretty significant shift recently where content becomes currency. People realize you can get a much deeper level of reach, relationship, et cetera, through some of the social media, some of the podcasting, webinars, other types of things. And so what was fearsome, what people were fearful of in the past, they've actually leaned into and realized it can be an economic driver for your business. And I think for us as a company, we've kind of gone through that same transformation where, the data that we have and some of the insights and analytics that we provide are proprietary IP for us, but opening up a little bit of that to the marketplace and sharing that we have subject matter expertise and that we understand the market participants, and we know the difference between a tenant rep and a landlord rep and how you can leverage data in each of those scenarios to get the best result. And if you're in the investment sales side, like we have insight into how you can do that, the podcast for us really became an outlet that allowed us to vocalize that and make it real for people. And so, starting off in 2020 where you're getting 50, 100, 200 listeners an episode to now where we're averaging 10 to 15,000 listeners per episode per week. It's been really remarkable. And the amount of interaction that we have with people has been incredible. I mean, we'll get a couple of hundred emails a week from people that listen to the show, that email in with questions or whatever. And again, it just creates opportunity for us to foster a deeper relationship with both our clients and non-clients. I think the takeaways for us is consistency matters. And I've seen this across all social platforms, not just with our podcast, but if you post frequently on your social, if you make yourself visible, you don't have to be selling anything. If you just make yourself visible, if you're willing to help people, guess what? Like the same core tenets that make you successful as a broker of making sure you have a business card and you pass them out and you talk to people and you lend a helping hand without trying to get paid on the first point of contact. Those same type of values apply themselves across the social media spectrum. And we've really just tried to take it as a organic, type of avenue for us. We haven't really, we haven't hired anyone to help us with this. We haven't tried to monetize this at scale. This has been something that we've really just done as a way to get some of our stuff in the marketplace. And it's been super positively received. I mean, if I thought we'd be at 1.2 million listens after a couple of years, it's just really incredible to see people's reaction. But the fact that we haven't missed an episode over 3 years, almost 4 years at this point, That consistency matters. People want to see you or hear you on a consistent basis, because then they can start building you into their routine, which is super important.
Absolutely. And I'm sure you probably noticed this, that there's almost a period of time where you're going through the motions and you're producing content at a regular clip, but the listens may not be there, or maybe the engagement isn't quite there, and then all of a sudden there's like an inflection point. And I'm sure I listened to a podcast that you had with Bo that you referenced, when the banking thing, when things started becoming tumultuous in the banking markets, for whatever reason, you saw a huge spike in your listenership in that period of time, and obviously that's continued on going forward. So you never know when that opportunity or the growth will come. It's all about that consistency. So
agreed. Listen, it's awkward for everybody to put yourself
Mhm.
out there and like get on camera, listen to yourself talk, see your goofy smile on camera. Like, we all have this vision of what we look like and sound like and whatever. When you start seeing yourself played back in a different form, it takes a little getting used to, but I would encourage people to push themselves in that area. Like, if you've got 10, 15, 20 years experience in the marketplace, people can benefit from your knowledge and experience. And if you're brand new to the space, you can bring some technical skills and a different perspective to the market that maybe some of the, more seasoned folks in the industry didn't get to experience, because the technology wasn't the same when they started out. So, I would just encourage people, even though it's a little bit awkward at first. Yeah. And to your point, you can't be numbers focused immediately. Like, the results don't come immediately. But if you're consistent and you're adding good content and your motivation is really, I like that you said in my introduction that have the heart of a teacher. Like, I try to live that out. And I think as a company, we do a really good job of that too, of just saying the money will come, the revenue will find itself. But if you're adding value for people and you're creating relationships with people beyond the revenue, that's where you really find success. And so that's something I would suggest for your listeners and others in the industry. It's just like building your business. It's just using technology and social media as kind of a new form or new medium.
Absolutely. And in addition to what you're doing already, because obviously as a broker, we do have those conversations on a daily basis with our prospective clients. But again, our objective as brokers is to become an advisor. And part of being an advisor is being able to consult and provide insight into what, the market's doing, or any other multitude of different things that we do on a day-to-day. And so, obviously these types of mediums are phenomenal opportunities for you to be able to showcase your expertise and over time build that trust with whatever audience you're trying to target. So
Imagine if you're breaking into the space today. It used to be, you look at somebody's resume that'd been in the business for 20 years. You couldn't fast track that experience. Like, the only way for you to get the same level of knowledge was to go through your own 20-year endeavor. But now there's so much knowledge being shared real time from people that are in the business at scale that you can ramp up at a much more rapid pace, and you can become, like, to your point, an advisor, a counselor, somebody that actually understands the nuance of your local market, of the property type, et cetera, at a pace that just wasn't available 20 years ago. Just because now you can log into a podcast, you can find 5 or 6 podcasts that talk specifically about the niche that you work in, and you can become an expert at that at a much more rapid pace. And so I hope people just take advantage of that, because it's kind of a blessing relative to folks that have been I've been in the business 23, 24 years. And I can promise you, when I started out, you really needed somebody that had been in the business for some time to kind of take you under their wing, to kind of get you in the fold and introduce you to people and kind of get your trajectory started. And now you can honestly start that same, fast track trajectory just by creating an interesting social media account that shares what you're hearing in your meetings with prospects throughout the day, or what you're seeing at conferences or reading in publications. It's a really amazing, powerful tool that I hope people start to leverage more.
Absolutely. Couldn't agree more. So, well, awesome, Lonnie. I want to make sure we have a little bit of time at the end of the meeting to be able to answer any questions outstanding from the audience. So if you guys are watching this right now on all the different social platforms, feel free to type away, ask your questions. I know Lonnie will be more than happy to provide you all with some insight. So we got a comment here from Anthony. So, hey, Anthony, good seeing you on the live stream. Thanks for the questions. Obviously, Lonnie is the expert here, so I'm excited. It was great to have him on. So, all right. So, in the meantime, while we wait for some questions to come in, Lonnie, is there any question in particular you wish that I would have asked, or maybe some interesting trend that you're following that you think would be of value to the audience?
I think it's something that's not discussed enough is the insurance challenge that I mentioned earlier. So I think that's something, if you're on the brokerage side, you should probably get a little bit of education around what's happening in your local market as it pertains to property insurance and the cost associated with that. So it used to be something that was just a coastal challenge if you're in Florida, California, Texas coast, et cetera. And we're starting to see that become much more pervasive across the US, where insurance as a line item is dramatically increasing. And you're also seeing insurers pull back in a couple of ways. One, a lot of them are not writing new policies. And two, when they do write policies, they're providing a lot less coverage than what you were getting in the past. So that's one of those things that, as lenders start becoming more familiar with those challenges, that could be something that snags deals outside of just the cost and underwriting component. Not having enough insurance or not being covered for enough climate related type of challenges is something that I think is going to be a challenge. And honestly, like a lot of brokers in the market, like that's not really been on the radar because it's never been something that's risen to that level. But I definitely think over the next 4 or 5 years, you're going to start seeing that become more and more problematic for people. And so if you can get a head start on that, I think would be very advantageous for the industry. I think broadly, we covered a pretty good swath of the marketplace. I think, I think the optimism is required. And as brokers, you have to be optimistic by nature. You have to make 100 cold calls before you get someone to take that meeting. Like that's just the nature of the business. So I would view this as an opportunity. There's going to be distress in the market. If you can become educated, informed, do your due diligence, be ready when those times come, and they're going to come, there's going to be some real opportunity to make a name for yourself and make some real revenue. And so, depending on where you play in the space, if there's anything I can do to help anyone that's on today, if there's anything that we can do as a company at Trepp, I'm happy to share my contact info. We do a couple of monthly webinars. One's called the Market Pulse webinar, very similar to this. Myself and my colleague Stephen Bushbaum, we do a monthly webinar where we just kind of talk about current events in the marketplace. And sometimes we'll bring guests on. Last month, we had Jay Parsons from RealPage on, and we talked about multifamily. And so, if you want to see a little bit more of what we do beyond just the audio version of the podcast, we do have our own, webinar series that comes out every month, and we're accessible. I mean, if you can't tell from this, I'm a real estate junkie. I love this stuff. And, I'm happy to help however, whenever I can.
Absolutely. And obviously, as you mentioned before, being educated about what's going on in the marketplace, not only on a national level, but also on a local level, and following, podcasts like Treppwire. Again, I highly encourage you guys to do so, because you guys do provide phenomenal amount of insights. And when you're having conversations with prospective owners or investors or whatever else, those are the data points, and those are the information you guys are going to need in order to make sure that you can showcase the value you have in the marketplace. So definitely great advice.
Yeah, and real estate is local and sometimes hyper local in its markets. I mean, like the national headlines are very important and impactful just to kind of get a sense of macro trends. Like when I was in Kentucky doing the market update with you guys, it was really interesting. You guys had an industrial panel that day at the seminar, and hearing the industrial brokers start talking about a little bit of the pullback in the large 1 million square foot type of spec space development, and how, that was making them a little bit nervous. They'd seen a slowdown in local absorption for those really large, spec spaces. And that their, comfort zone was really in those 250 to 400,000 square foot industrial buildings that could be demised into smaller spaces. That's that type of local insight that you're not going to get from a national headline. Like industrial nationally, still on fire, still doing great. And it didn't mean that in Louisville that there was like some real retreat in the industrial space, but there was definitely some nuance from the participants there that were saying, hey, we've got enough data now locally to say you're not going to see a bunch of new 1 million square foot spec spaces coming out of the ground here anytime soon. Like we've seen that there's been enough slowdown that we're going to pivot to a slightly different model. And that's where that local knowledge and expertise really starts to come into play.
Definitely. I could agree more. All right. So Philip asks, he said, no questions. Thank you for the overview. So really the question is, do you believe that the office market's going to take roughly 10 to 12 years to actually clear and obviously get to a point where it's kind of stabilized at that point?
Yeah. So I would say Broadly, I think the market probably comes back quicker than that. But in those markets, LA, San Francisco, Chicago, Minneapolis, that have had just such a huge influx of sublease space, you're looking at just mathematically, it's that 10 to 12 year mark. But I'm also cognizant of the fact that, guess what? If interest rates come back down, we go into a recession and rates go back to zero, guess what? A lot of those things become a lot more marketable than they do now. So assuming that things stay on the similar trajectory, you're going to have office markets that are depressed. But at the same time, you have a lot of offices that are doing really, really well. If you're in a sub-institutional type of office market where maybe 50,000 square foot or less, predominantly leased by local tenants, those offices in a lot of places are actually seeing rent growth. And so it's the broad brush doesn't always paint the right picture. But LA, San Francisco, Chicago, Seattle, Atlanta, DC. I didn't even talk about DC. DC is probably the biggest ticking time bomb right now, not just for politics, but in the office market too, in the sense that the number one tenant in the office market in DC is government space. Like government tenants occupy the biggest swath of space. They've been super laissez-faire with return to office. And as long as that attitude continues, you're going to see a huge decline in office valuations in the DC market. And what we started to see with our data is that decline in value for the office sector in DC specifically has really trickled down not just to retail, but also to multifamily. So it's logical that retailers, restaurants and other things that survive off of the foot traffic from people being in the city going to the office, like that's a logical reduction when there's no people in the office. The multifamily stuff is a little bit beyond what we've seen in other cities where DC office rents drove a lot of the high-end multifamily rents. So as people were in their offices and needed to be close to the buildings for work, they would pony up and pay an extra $200 or $300 a month to rent that nice apartment that was walking distance to work. Now that they don't have to go to the office, they don't want to spend that extra $300 or $400 a month on rent for an apartment. They're moving a little bit farther outside of town, and you're starting to see some pullback on the Class A multi in the urban core there in DC. And so it's just really interesting to see how interconnected a lot of these property types are, where a decline in valuation for office doesn't just impact office negatively. It actually has trickle-down effects across the other asset classes.
Definitely. Also, those are some great insights. All right, so we have one more comment. Hiram, just again, he thanks you for the great insights you've shared thus far on the podcast, and I would second that as well. So, all right, Faye. All right, so Faye asks, do you have an insight on the industrial market in the Mid-South, so Atlanta, Memphis, distribution hubs, et cetera?
Yeah, so I think industrial, as we mentioned earlier, is probably, if not the strongest, one of the strongest asset classes even today. There's definitely been a little bit of a slowdown in some of that spec development. I mean, Amazon effectively did 20 years worth of new spec development in about a 5-year period. So with them announcing about 18 months ago they were going to start pulling back, you've seen a little bit of that ground up stuff slow down some. But outside of that, there's this insatiable appetite for industrial, and that last mile distribution concept is only going to continue to grow, especially in markets that have positive net in migration. So if you have people moving there and there's more rooftops being built, that last mile distribution becomes even more needed. The biggest challenge for industrial right now, there's two challenges. One, if you have long-term leases in place that don't allow you to get those rents to market, that's problematic for current owners. And we're starting to see that at scale. On the office sector, if you're trying to refinance your loan, the lender wants to see a longer weighted average lease term because they have nervousness around that sector. On the industrial side, if you have a really long weighted average lease term and those leases only allow for a 3 or 5% kicker every year, and you've seen your market see rent growth of 25% in the last 6 years, or 4 years or 3 years, you're locked into those leases. That's a net negative for the value. So that's something that's kind of interesting to kind of see play out in real time. Like newly developed spec space are capturing 100% of that available rent return. Whereas if you have long-term leases in existing buildings, you're locked in, and there's upside, but at some point that upside, because the market's going to slow down, you're not going to realize it. And the other challenge for industrial, and in those markets, maybe not as much, because I don't think they've seen such an explosion like you've seen in some other markets, Virginia, Texas, et cetera. is just this the NIMBYism concept of how local municipalities have really started to push back on any more warehouse or distribution type of development. So it's amazing. You fly into any major city in the U.S. now, it's not uncommon that you just see these huge industrial buildings, flat roof, not just around the airport, but really dispersed around the communities. And I've seen and talked with a lot of folks in the last 6-8 months where they're having a lot more difficulty getting things through planning and zoning for industrial development, because a lot of the neighborhoods have said we're not wanting any more industrial. So that's kind of an external factor that probably hasn't reared its head yet. But that would be something I'd keep an eye on. Outside of that, I think both those markets have potential to continue to grow. And there's a lot of unrealized value in some of those long-term leases.
Yeah, most certainly. Yeah, in Memphis, I believe, is it FedEx or UPS? I can't remember what's headquartered in Memphis, but they've got a pretty.
Yeah, that's that. That one that's kind of to maybe take a little contrarian take. UPS announced last week 12,000 layoffs, right?
Mm-hmm.
So, could that, if that becomes systemic, if that becomes something where all of those carriers start laying people off at that type of number, maybe that does cool down the sector some. But we haven't seen that happen yet. And I think UPS is a little bit unique in the sense that they just did a large labor agreement about a year ago, where their fixed cost went up significantly with the labor unions, and so kind of necessitated the layoffs. But that would be an interesting wrinkle, especially if they have a higher concentration to one of those in those markets.
Definitely. All right, we'll give it about a minute left before we kind of round out. We're running up right on the hour, so. All right, if you guys have any more questions, feel free to type away in the chat box. We'll give you about 15 to 20 more seconds, and then we'll go ahead and round it out. Okay. Well, it looks like you've answered all the questions, Lonnie. First off, thank you so much for taking your time today. I know you're extremely busy. You're always traveling. I always see you on LinkedIn posting about all the different places you're traveling to. So again, we just really appreciate the time you've taken to be with us today. So if people want to learn more about you, get connected on different social platforms, what's the best way to be able to do that?
Yeah, so I'm on Twitter, which we now call X, I guess. I still call Twitter. I'm a rebel. I'm just at Lonnie, LONNIE _CRE. So check me out on Twitter. If you want to connect on LinkedIn, obviously I'm on there as well. If you want to email me, it's pretty simple. It's just Lonnie _Hendry at Trepp.com. So it's as my name's spelled out on the screen here, at TREPP.com. And yeah, happy to connect. I definitely appreciate the opportunity to come on and talk real estate with you guys, and looking forward to maybe doing this again in the future.
Absolutely. No, I'd love to do this again in the future. And really, I think, again, we just appreciate, all the insights shared. We'll make sure to include all the different, handles and emails and everything you've just described in the show notes. If you guys are watching this on YouTube, it will be in the show notes. And if you guys listen to us in a podcast format, whether that's Spotify, Apple Podcasts, really any other medium, will be in the show notes as well. So again, Lonnie, thank you so much for your time. We obviously greatly appreciate you stopping by. If you guys like this channel, please like and subscribe. It does make a huge impact in our ability to reach a broader audience. Along with that, if you guys enjoy this content, we do this every other week where we invite speakers who talk about a variety of different concepts pertaining to commercial real estate. So continue to come back, continue to engage, and we look forward to seeing you guys next time. So thanks again so much for tuning in, and we'll see you all next time.
Thank you.